Welcome to the Investor Coaching Show, a podcast to help you get an insider's view of the financial world and escape common investment traps. We look at the financial news of the day and help you make sense of it so you can relax about money. And here's your host, Paul Winkler.
And welcome. This is the Investor Coaching Show. I am Paul Winkler. We talk money and investing around here. Along here with Mr. Jim Wood hanging out with me in the studio today. And man, it's getting like frightfully close to Christmas. Frightfully. And Louie's not playing any Christmas music yet. I just got to pick on him.
We could sing some carols.
You think you want to sing some carols? All right. Well, maybe next week we had to do that.
Maybe next week. The week after that.
Maybe the week after that. No, we're not going to do it the week. Yeah, Nick was just saying it was Dick Van Dyke's 100th birthday today.
Yeah.
Really?
We were singing the praises of Mr. Van Dyke.
Mm-hmm. There was an article, I think it was the Wall Street Journal maybe, someplace, about his 100th birthday. And if you live that long, will you run out of money? I think that's probably
quite the segue.
That is it. You like that? Wasn't that good? Wasn't that really good? So the reason that comes up is because we had this one article I shared with Jim before the show, and I said, we ought to talk about this. We really ought to talk about this. It was about it was in the Wall Street Journal. Big thing pops up, and it was this whole thing by Vanguard Investments, a fund company that I love to just pick on. Not because we represent any fund companies or, anything like that. It's just when I hear fund companies talked about all the time as just being the bomb, and I just get real frustrated. Full disclosure, we don't use them for anything except for people's 401ks. I might use their funds when people have 401ks and they come in here and I'll say, hey, I'll use this and that. I won't use them exclusively. Typically, I'll choose various things in there. But there are a few areas of the market that they do a really decent job. Large U.S. companies, fine. Large internationals, fine. A lot of the value stuff, not as happy about, or the small cap stuff, not as happy about because of the way they manage the portfolios. But I think investment philosophy-wise, a lot of times fund companies, not just them, other competitors of them as well, they will be so myopically focused on one thing, and that is just expense of the portfolio. Now, the very least expensive area of the market to manage in an investment portfolio would be big companies, just because it's a really cheap area. But the problem that you run into is you can have tremendous risks when you're dealing with those market segments, especially right now. I say especially right now. In the late 90s, you say, well, what area of the market was the cheapest to manage large U.S. stocks? Well, what area of the market went down the most? In the early 2000s, large U.S. stocks. What areas of the market struggled the most for an entire decade, that particular area of the market? So you can run into some serious problems. But they had this whole article about the 60-40 portfolio, building portfolios for the next decade. It was an interview. And they were just falling all over themselves, excited about interviewing. This lady named Christine was interviewing this person. She says, welcome to Better Vantage by Vanguard, a podcast series hosted by custom content from Wall Street Journal and Vanguard. And I just kind of wonder, did they pay for this? I don't know. What was the deal here? And then they have this guy, Joe. He says, I'm excited is what he says, starts out the interview. And Christine goes, yeah, I am too, because today we are joined by a very special guest flying in from London. And all I can think is, Jim, as I'm reading that, the expert from out of town.
Oh, I thought you were going to say, boy, were his arms tired.
No. I was not thinking of that. Flying in, it was a she that was flying in. So she's flying in from London. Please welcome, what's it, Jemana, I guess is how you pronounce her name, who's their chief economist for the fund company and head of investment strategy group in Europe. Welcome. And Joe says, and she says, yeah, thank you. Appreciate it. Great to be here. Blah, blah, blah. Joe says, I have the pleasure of working with her. I think the listeners, Christine, what we'll get today is, you saw in the title of the podcast, 60-40. So what does that mean? Now, the reason I'm spending some time on this, folks, is this is something I just taught an entire workshop on how to take income in retirement and the myths about taking income. When we invest for retirement, what the heck are we investing for? We're investing so that we can live off of the portfolio or the money that we set aside for retirement. And what do we want to do? Well, we want to make sure that we have this so that it lasts as long as we do, if not, well, hopefully longer than we do, and that we don't run ourselves out of money. And we talked about this last hour. We talked a little bit about, when I own companies, I own living, breathing organisms run by people that are their whole reason for being is to make earnings for the company that is owned by who? Us. So it says here, this podcast, the title of the podcast, 60-40. So what does that mean? Says Joe. It says, well, where did those numbers come from? We're talking about asset allocation, portfolio construction, which is really fundamental to all our long-term success. Whether your number is 60-40 or not, 60% stocks is what they're referring to there, 40% fixed income. We're going to get into that. Now, what we found, let me just back off. He says that asset allocation is important. And you look at the research from Brinson and Biebauer, the studies on how important it is. How important is it, Jim?
It's almost everything. Right?
Yeah.
It's over 90%, depending on what year they did the study, 91%, 94%, and all the other stuff, stock picking, market timing, and doesn't have a huge effect, and the effect it does have is typically negative.
Exactly. So when they engage in trying to figure out which stocks are better than others, when they engage in market timing, and typically what do we think of as market timing? What's the most basic process of market timing be considered?
I'm in cash or I'm in the market.
That's exactly right. Two asset classes, two asset categories. How much do I have in fixed income on the sidelines, or how much do I have in stocks? If the stock market is about to go up, reduce fixed income, throw the money in stocks. If the stock market is about to go down, pull money out of the stock market, go into cash. Now, do you ever see where people go wholesale, pull everything out of stocks and throw it all in cash, and then before the market's going to go up, they pull it all out of cash and throw it in the stock market?
No.
Nobody ever has the confidence to do that. And you'll listen to the investment industry and say, we can't do that. No, you're right, you can't. No, you're right, you can't. But here's the thing you got to keep in mind. This is a workshop. This is a line from a workshop I have taught for, I think we're going on 27 years now. And what I said in that workshop is that there is typically two ways of thinking about market timing. One is in its purest form. I'm 100% in stocks, and then I want to move to cash when I think the market's going to go down. Or I'm 100% in cash, and I move to stocks when I think the market is going to go up. That's the, just really the dichotomous, type of view on this. Just do those two things. That's all I'm dealing with. Now, the other form of market timing is this. I have this diversified portfolio. I have large companies and I have small companies. I have large value and small value and international large, international small, international large value, international small value, emerging markets large, emerging market value. I got 5-year bonds, 4-year bonds, 3-year bonds, 2-year bonds, and 1-year fixed income in my portfolio. And based on what's happening out there, I'm going to shift between a little bit more in small cap stocks because I think that the time is ripe for small companies to do well. I'm going to shift a little bit more there. Now, this is market timing with 15, 20 different asset categories. So could they do it when they're only dealing with 2 asset categories? Were they able to do it? No.
Of course not. Yeah.
Did they make it any easier when they decided to do this between 15 to 20 to 30 asset categories? No.
Makes it easy to bamboozle people talking about it, though.
Oh, yes. It is very confusing, and it makes you sound so sophisticated. So basically what it says here is this. It says, when talking about asset allocation, that's really, really important. But what can we do to increase returns? What can we do to increase your odds of success? And it says that at the end of this episode, this lady, who's the chief economist and head of investment strategy for this huge mutual fund company, is going to make it all make sense. They're going to settle the debate.
Yeah, I must have lost the last 5 pages of this because I read through what you gave me.
Yes.
And that didn't happen.
Oh, didn't? I didn't. It wasn't all clear to you by the time she was done?
It wasn't, but I was hoping there was more.
Oh, Jim, you're just not the sharpest knife in the drawer. It must not be, right? He's more like a spoon, right, Nick? No, it is not that. You're right. She did not make it clear. We know the U.S. only, she said, she's talking about the 60-40 mix. We know that the U.S. only 60-40 delivered an annualized basis, an average 8% nominal return. No, I'll take that anywhere, she says, any day. That's really impressive. So 60-40 is timeless and time-tested. However, when we speak to advisors, we speak to investors, what we're actually hearing is the conversation is evolving.
Yeah, I love that.
Didn't you love that line?
Yeah.
We're evolving. Well, wait a minute. Are you telling me what you were telling us before was wrong?
Right. It's literally like it's time tested and timeless. Oh, but it's evolving. Well, wait a minute. Which is it?
Yeah, exactly. This is not. I hate the word evolution anyway. But there is still this debate around it. And then has 2022 something to do with it? She asks. Well, yes, absolutely. Well, why would 2022 come up in this whole conversation? Because you guys screwed up and you held the wrong types of bonds in your 60-40 portfolio. And you held longer term bonds. When interest rates went up, your bond funds crashed with stocks. And you didn't have the shorter term bonds in there. Now, in an investment portfolio, when you're talking about a portfolio you're going to take income off of, maybe you'll have 60% stocks, but you don't just want big U.S. companies that went crash in 2022. Now, if you did smaller value companies, they were not as negatively affected by any stretch of the imagination. They were down like 2 or 3% that particular year. It wasn't this big downturn. If you looked at cash, it went up that particular year. And that is why the investment industry abandoned this idea in 2022. It's because a market condition happened that they just did not have in their playbook. Didn't know that was going to happen.
Right. And it was the worst year in bonds since 1937. And bonds, even the short-term high-quality bond funds went down. But they didn't go down nearly to the degree that stocks, so they still provided quite a bit of diversification benefit in that portfolio.
But what they had in these portfolios weren't even that.
Right, exactly.
I'm talking about their portfolios.
Yeah, and I was talking about ours.
Yes. Yeah, exactly.
Yeah,
and you're right, exactly. Because, if you do it right, you don't go with the really long bonds. You don't go with the low quality stuff. You were fine. But that's not what they did.
Right.
And that's why they're abandoning the idea here, and it frustrates me if you can't tell. So they go back to Joe, and he says, yes, it came under heat in 2022. I heard it in I read about it in the 1970s. I heard the 60-40 was broken in the 1990s, runaway tech stocks. That's why it was broken, because you didn't diversify the way Bengen talked about diversifying. When you hold... if you look at the 1990s, the early 2000s, value stocks actually went up. So this is the key, folks. When you're investing, you want in any given year, there ought to be something doing okay. And I'm telling you, this is something I've been preaching and screaming about from the highest rooftops, is in recent years, we're seeing an overconcentration of American investors on these AI companies. I had a conversation with a guy the other night We were talking about that. And he goes, Paul, what do you think about me doing this? Not a client. It's just, somebody I know casually. And he said, what do you think? And I said, don't do it. Do not do this. This is hurting bias. We have a tendency as investors to do what everybody else is doing. And this lady from Vanguard is basically, the whole beacon of the 60-40 is that balance where one thing goes down and the other thing is still giving you returns. Yes, that's the way it's supposed to be. Now she says, Christine goes, well, how do you go about doing that? How do you go about doing this? Now, I just told you how we would go about doing it. I am going to have large companies in there, yes, but I'm not going to have everything there. When 2000, 2001, 2022, you take years where the market has gone down, where large U.S. stocks have gone down, and international large companies have gone down, there are other areas of the market that have done just fine. You make sure you have them in there represented. Like so far this year, I've been, you look at the areas of the market that have been doing the best. I'm telling you, it's not areas that I ever see in people's portfolios. I just don't ever see them. And the reason was they weren't the hopping great things that, we think of as being, awesome, what we ought to be doing. And, because we don't, nobody's going to think about some of these companies outside the United States, for example. Some of these areas, these value companies. And here's the thing to keep in mind. Okay, so we look at this and we say, okay, how do you do this? And this is what they're saying. She says, well, what do you do? How do you go about that, she says. And what's her answer? What's her answer is this. When you think about the dynamic portfolio, okay, Jim, dynamic, what does that mean?
Oh, I caught right onto that. So it always has to have this like fancy word, dynamic. Yes. It's dynamic. We're going to be active and moving things around, and we're going to be dynamic, and we're doing stuff all the time.
It sounds so sophisticated.
Yeah.
It really does. She says dynamic. What does that mean? I can give you of a couple examples where if you're taking a view on the market, and what I mean is, where's the market going to go, she says.
And that's why I just want to scream, stop right there. Where's the market going to go?
Yes.
All the talk about, you go through and they talk about evidence-based, this and that and stuff, but yet they're forecasting the market, which has just already been shown time and time again to not work. People are paid 6 and 7 figures to consistently forecast the future, and they consistently get it wrong, yet they still get paid.
Uh-huh. And Jim, I would walk in to do this show every week. In the early years of the show, I would walk in. There was a guy in the booth next to me at the station, and it was a sister station for the talk radio. And he would walk in. He'd see me. Hey, Paul, what's going on, man? He yelled to me across the way. And I said, hey, buddy, what's happening? And he said, hey, Paul, what's the market going to do? Like her question right here. What's it going to do? Now, my answer wasn't telling him where it was going to go. I would just go, it's going to go up. It's going to go down. It's going to go up. It's going to go down. That's the right answer. What's it going to do? It's going to go up. It's going to go down. It's going to go up. It's going to go. And he would laugh. He'd go and do his show and I'd go do mine. But she's not joking. Where's it going to go? Those are the sort of market views. She says, so you're making an active bet. You're taking active bets.
Gambling. Betting is gambling.
Betting is gambling. More about this after this break. Let's take a quick break and come back after this because I want to spend some more time on this because you've got to know what not to do when it comes to investing so often. Hey, just a note to you podcast folks, we just came out with a retirement income guide and I'm super excited about this. There are all kinds of myths about taking income in retirement. People worry about running out of money, and rightfully so, because a lot of these myths can actually cause that. Now, the myths that you typically hear about, number one, dividends, living off dividends in retirement, real estate, life insurance as a retirement investment, and annuities and interest-bearing accounts and target date funds. There are all kinds of things out there. What I want to do is put something together that walks through why those things are problematic, number one. Number two, the other thing that I wanted to do is walk through the evidence-based research on taking income in retirement. And we got a ton of data going all the way back to 1900. what's the logic behind it? And it's intensely logical. So we put that together, and all you have to do to download that, making it super simple, just go to paulwinkler.com/relax, and you can actually get into that very easily right there. So I would urge you to do that. Check it out, because I think you're going to really like it. paulwinkler.com/relax. All right, back here on the Investor Coaching Show, Paul Winkler talking about the world of money and investing. Okay, let's see. Jim, we're talking a little bit about this whole Vanguard thing, that this interview regarding the 60/40 portfolio. Okay, so when I'm taking income in retirement, I have to say, okay, so where am I going to get income when I'm no longer at work? There are portfolio designs that show anywhere from about half stocks to about 75% stocks. In the workshop that I just taught, I used 75% because I was starting the data in the workshop that I just taught Thursday in a year that was absolutely abysmally awful for starting. If you had to pick a year not to retire, for a lot of people, it would have been the year 2000, because you had the market was down in 2000, S&P was anyway. 2000, 2001, 2002, 3 years in a row. That's a sequence of returns nightmare, if there ever was one, if you're not diversified. But over the same years, 2000 and 2001, you had large value, and value stocks in general went up in value. And bonds, 2002, my goodness, the intermediate bonds actually shot up in value that particular year, and you were just fine. And what happened is in 2008, you had kind of a mess. And then the investment industry did what regarding 60/40 portfolios?
Oh, it doesn't work.
It doesn't work. 2022, it doesn't work. Every time the stock market goes down, the area that they're focused on anyway, because the diversification is awful with the big mutual fund companies. They just don't do it. If you look at the target date funds, and I actually show it in this workshop that I taught, I actually go through the major fund company. I look at Fidelity, I look at Vanguard, I look at T. Rowe Price, I look at American Funds, I look at State Street, I look at Voya, those 6 different fund companies. It was just because I'm not going to go forever, but I'm going to tell you that if you look at their asset allocation portfolios, overwhelmingly focused on just one area of the market. And that is the problem.
Yeah, and it's surprising how universal it is when you look at those target date funds, or even most of the asset allocation funds. It's the same thing. They're top heavy. They're like an upside down pyramid with Apple, Nvidia, the big 7, all those at the top. And then they say they have small companies and things like that, but they're all just jammed in the bottom point of that upside down pyramid, and they don't affect the portfolio much.
And you look at how many 401ks, and this is like 80%, they're bragging right now. These fund companies are bragging that over 80% of people that are investing in 401ks are focused on these portfolios. This isn't an isolated thing. This is where most people have their money. So this is why I have to talk about it a lot, because it is the reality that that's what most people are doing. And it doesn't become a problem until those market segments come crashing down. And it did. I saw it happen. I screamed at the top of my lungs when I started this show in 2001. I screamed at the top of my lungs in 2002. And I'm just going to do it now, because I think that it's really important that you recognize that you have to be aware of whether you're really diversified. I've been seeing articles recently on how many 401k millionaires there are right now. I said, well, for right now. If the same thing happens that happened in the early 2000s, that's going to go away in a big hurry. You have to make sure that you are aware of this stuff. Now, she talks about here, she says, you're taking active bets. I want to go back to this interview with this lady that's chief strategist and chief economist, investment strategist. It says, you're sort of making an active bet. You're taking active bets. Again, talking gambling. Then in that case, if we think about the 60/40, what could evolve into where some part of your 60% equity, instead of being an index fund, could be an active fund? And the 40% bond holding, instead of being in a fixed income that's index related, you could be active related. So basically what were index funds designed for, Jim?
Just capturing the certain areas of the market at a low cost.
And it was designed on the idea that stock picking doesn't work.
Yeah. Well, that's what this whole thing
and
is.
Market timing.
It seems like they're talking out of both sides of their mouth.
They are. It was designed based on the idea that stock picking and market timing are a fool's game. And yet, what is she saying? Oh, let's do stock picking and market timing alongside of indexing.
Right. Well, you have an opinion where the market's going to go. Well, you can just, just adjust on that opinion. And, it's rather than following any evidence or discipline or anything like that. It's, whatever you feel is right.
Yeah. And here's the term they use. You ready? Time varying asset allocation. It's in the interview, about one line below what we were just talking about, Jim. If you look just down a little bit lower.
Yeah.
Time varying asset allocation allows you to take on different forms depending on what the model is telling you. Oh, what's the model telling you to do right now with your money?
Well, with that, you get model risk.
Yeah.
I'm just saying that facetiously because that's what they point out in here. Well, it's just like, duh. I mean, your model's only be as good as your model, and models aren't predictive. They can tell you some information about what things look like today, but your model isn't going to predict the market. If models could predict the market, there'd be, all these active managers would be hugely successful, and that is not the case.
And it is not the case. There is absolutely no evidence for it whatsoever. So, we look at this and it says, well, I don't have, you see a lot of them on TV. They talk about investment philosophies, methodologies, and she says, well, I don't have any data. Oh, great. That makes me feel really, really good. But I just have a really good feeling. My gut feeling tells me this. I'm going to make a call on this. It's purely narrative based. On the other side, you have very, very deep evidence based. Using evidence based language. This is what bugs me. She's using the term evidence based. What does evidence based mean? That means it should mean that there's a lot of deep evidence to show that this is, a valid way of managing money. Systematic models, lots of data, lots of correlations between different markets. And you look at the past and make judgments based on the future. And she says the word judgment. Yeah, judgment. Judgment is key. There's always this thing about being, there's going to be a little bit of judgment, which means what? It means I'm judging. I'm making a guess as to what's going to happen. No, let's not call it judgment. Let's call it guessing.
Well, if you're looking at evidence-based models, if you're looking at decades of empirically tested data, then you're not going to do that. Mm-hmm. I mean, that's the whole point, is if you're looking at the data and, something that's actually been looked at from 1,000 different ways, mm-hmm. and they come to the same conclusion, is that stock picking, market timing aren't likely to work. But it's just ignoring all that and saying, well, yeah, we're just going to look at some, I don't know if they're looking at shorter term evidence or what to get to those conclusions. But if you're looking at the true evidence over time, it just says, don't do it.
I mean, and I'll give you a little audio from this, so if you listen to what she has to say, and this is just straight from the horse's mouth. This is straight from the interview.
Where is the next frontier, if you like, on balanced investing, having capabilities to tilt your portfolio so that you can take advantage of your situation and the market situation?
That's it. Where can you tilt the portfolio? You can take advantage. And what is happening here is if I am getting rid of something because I think that that's not good and I'm buying something else because I think it is good, I am buying it from somebody that thinks it's going to go down.
Yeah, I would just love to be able to ask questions along that interview. Well, how do you do that profitably, consistently?
Yeah.
How do you take advantage? If I feel strongly about something and I want to do it, what are the guarantees that my gut feeling is going to outperform what I would get in market returns? And of course, that's ridiculous. That's a ridiculous question.
Yeah, and precisely. So if we look at what they're thinking that their job is, they think their job is to make money for you, right? And I like what John Bogle himself, the founder of Vanguard, had to say regarding this.
The job of a corporation, the corporation that's running funds, essentially is to earn a return on its capital, not a return on your capital, you being the mutual fund investor.
So you just think, is he rolling in his grave as he's hearing this kind of stuff? Because Bogle was the founder of Vanguard.
And you had talked about kind of how we like to pick on Vanguard, and this is a big part of the reason, because they act holier than thou, typically because they have funds with very low visible fees. Now they take a lot of shortcuts to get those fees, and we've talked about that time and time again on the show, but that's the thing. And then you get stuff like this that is just coming way out of left field in terms of, capturing market returns, prudent investing, and all that, and say, well, yeah, okay, but all that's nice, but if you have a good, strong gut feeling and think you can predict the future, you ought to do it. And that's, the 60-40 portfolio that might be really is just a phrase that might really mean an 80-20 portfolio, which they said earlier in there too. Really, it seems to me a lot of these answers turn out to be this word salad garble. Mm-hmm, and, and it sounds okay if you're not listening too closely, but you really start analyzing some of this and you really start shaking your head.
And just one last point on this. I'm just going to go over this line. It says, if we think about 60-40, you think about where it could evolve for where, she says, some part of your 60% equity, instead of being in an index fund, could be in an active fund. And the 40% being bond holding, being in a fixed income that's index related. Now, what did Nobel Prize winner Harry Markowitz, Nobel Prize 1990, have to say about this? You heard it from me a second ago, but it's kind of nice to hear it from the horse's mouth.
Michael Jensen in the 60s said, let's measure actual money managers in terms of risk and return. Let's do performance measurement, not just in terms of how well they did over the last 10 years, but in terms of standard deviation versus average return, what their volatility versus their average return was. And he found that on the average, money managers did not outperform the market, or few if any, and on the average, they did not outperform the market. This was work that came out in the 60s. One of the results of that was the emergence of index funds when the folks at Wells Fargo saw that on the average money managers did not outperform the market. They said, well, let's make it easy for you to buy the market. So that became the start of the index fund industry.
And that's why they invented it. And basically what's happening is they're going back to the other side, literally, at one of the companies that started. Oh, they're one of the two companies. Wells Fargo's one, Vanguard's was the other.
It's kind of ironic too that Wells Fargo actually, according to Bogle, they started index investing because they had so many problems years later with.
So true. And it's just this. The point being here is this: mutual fund companies can talk a big game when it comes to diversification, and they can talk a big game in terms of not engaging in active management. Watch what they do. Hey, this is Paul Winkler. Hope you enjoyed today's edition of the Investor Coaching Show. If you want to learn more about what we do, go to our website, paulwinkler.com. Until next time, I'm Paul Winkler, reminding you that I believe that more educated investors are more confident investors, and confident investors are more successful investors. Have a great one. Advisory services offered through Paul Winkler, Inc., an SEC-registered investment advisor. The opinions voiced and information provided in this material are for general informational purposes only and not intended to provide specific advice or recommendations for any individual. To determine what investments are appropriate for you, please consult with a financial advisor. Paul Winkler, Inc. does not provide tax or legal advice. Please consult your tax or legal advisor regarding your particular situation.